the shield just fell. For over a century, the two largest banks in Canada, RBC and TD, operated under a quiet, unspoken guarantee, a kind of systemic protection that virtually immunized them from the kind of existential threats that have vaporized institutions in the United States and Europe. But in a single, almost silent policy move, Ottawa just dissolved that guarantee, forcing the titans of Canadian finance to rip up their playbooks and reevaluate their entire balance sheet. What we are witnessing is not a scandal, but an unprecedented stress test of a national economic psychology. The news itself, a seemingly bureaucratic adjustment to how certain internal low-risk capital is classified and valued, was the fuse. The deeper question is, why now? Canada's banking sector has been the global envy, a bedrock of stability that weathered the 2008 crisis with remarkable resilience. Their secret was simple: the perceived impossibility of failure. This new regulatory stance, which is a structural move away from long-term, low-cost domestic capital protection, shatters the psychological contract between the government and the financial giants. It represents a systemic recalibration of risk, moving from the nation to the shareholder. Here is the surprising fact. This wasn't a sudden regulatory crackdown. It was a quiet move, a strategic collapse of the too-big-to-fail doctrine, decades in the making. The implicit state guarantee allowed these banks to sustain a lower cost of capital, giving them an inherent, unassailable competitive advantage both at home and globally. It acted as an invisible, interest-free subsidy funded by the collective confidence of the nation. For every multi-billion-dollar acquisition or global expansion TD or RBC made, this safety net was padding the fall. This new move is the official retraction of that parachute. It is a fundamental shift in the architecture of Canadian capitalism, signaling that the era of state-sponsored stability, which has been a powerful, silent engine of growth, is over. This is where the complex financial engineering impacts every family in the country. Banks, facing a new reality of higher capital requirements for certain long-term assets, must now do one of two things to maintain their profitability ratios: increase revenue or cut costs. For the average Canadian homeowner or consumer, this translates directly to a subtle but undeniable increase in the cost of credit. Your next mortgage renewal, your line of credit, or the rate on your small business loan will now carry a fraction of this new, heavier capital burden. It's the behavioral economics of the financial system. When institutional risk rises, consumer expense follows. The banks are recalibrating, and that means you will pay the price for their new, less protected risk profile. The explosive overview is simple. The regulatory change has been made. The psychological safety net is gone. But this story is far more serious than a mere accounting adjustment. The real consequence lies in the hidden mechanics of what this means for RBC and TD's vast, intertwined global operations. They have been quietly preparing for this moment for years, but their countermeasures reveal a far more aggressive, potentially destabilizing strategy than anyone in Ottawa anticipated. The quiet move by Canadian regulators was not just about increasing a capital buffer. It was an attempt to fundamentally alter the institutional psychology of the nation's two largest, most conservative financial operators. What was revealed in the immediate aftermath, however, is a far more aggressive set of countermeasures than the regulators had bargained for. The system they tried to stabilize is now poised to accelerate its risk-taking to compensate. To understand the core intrigue, we must look at the policy-level system known as Basel III and its domestic implementation. The Canadian regulatory framework historically provided domestic banks with a more favorable treatment for certain long-term, stable assets, a kind of home field capital advantage. This new policy is an attempt to align Canada more rigidly with the stricter post-2008 global standards, removing those domestic carve-outs. The deeper system at play here is not safety, but institutional competition. By raising the domestic cost of capital, the government is subtly pushing the banks to seek higher yields elsewhere. The psychology of a large publicly traded institution dictates that profit targets are sacrosanct. The minute the cost of operating at home rises, the pressure to expand higher risk, higher reward operations abroad becomes overwhelming. The surprising mechanism revealed here is the globalization loop. The Canadian banking giants have spent the last decade building massive footprints in the United States, particularly in the retail and wealth management sectors. This was their insurance policy against a domestic stagnation. The regulator's move essentially accelerates the strategic necessity of this international push. Their American operations, which are already subject to the tougher U.S. capital requirements, suddenly become more appealing relative to the newly expensive domestic operations. The stakes have just been defined. The banks are now incentivized to shrink their domestic growth and aggressively pivot to their foreign assets to seek greater yield. This creates a fascinating parallel. The Canadian government, attempting to strengthen their financial system's domestic foundation, has inadvertently poured rocket fuel into its global expansion engine. For the everyday financial markets, this move generates a significant connection to long-term stability. The collective market perception of RBC and TD has always been rooted in their stability, an image built on an implied state backstop. When that perception erodes, even slightly, the cost of capital, not just the regulatory capital, but the market's perception of risk, can rise. This means their ability to raise funds, issue bonds, and even the valuation of their stock may face a long-term adjustment. The behavioral insight is critical. Certainty is currency. When the government removes a core certainty, the market begins to price in the unknown, creating systemic friction. The market is not just pricing risk now, it's pricing regulatory unpredictability. The hidden mechanics reveal a great decoupling. The bank's future is now less tethered to its domestic stability and more reliant on its global maneuvering. But here is the part nobody expected. This quiet policy move has triggered an immediate, intense reaction from global financial centers, from New York to London. They view this change not as a local event, but as a chilling historical parallel, a playbook being dusted off from a crisis almost 2 decades old. New York and London are not watching this Canadian regulatory shift with academic interest. They are watching it with a cold, almost surgical intensity. This quiet policy pivot is being viewed through the lens of a historical parallel, a financial trauma almost 2 decades old, the pre-crisis signal that often precedes a major global repricing of risk. The core intrigue for global markets lies in the systemic nature of the shift. In the years preceding the 2008 crisis, regulators globally often employed a kind of regulatory forbearance, allowing banks to use softer internal models and assumptions for capital reserves. The collapse of that crisis forced a global move toward stricter, standardized capital requirements under the Basel Accords. The Canadian system, however, retained a more protected status domestically. Now the Canadian government is essentially re-Baseling itself after a period of major expansion. This suggests a deep internal policy fear that the domestic risks, particularly in the highly leveraged housing market, have finally outgrown the old protected banking model. The policy is a preemptive confession of systemic domestic vulnerability, a concession that the old architecture can no longer safely absorb the new level of national debt. The surprising historical parallel being discussed on trading floors is the quiet Japanese pivot of the 1990s. As Japan's economy and real estate markets stalled, its major banks initially resisted deep structural reforms. When the reforms finally came, they coincided with a period of aggressive, often less regulated global expansion as the banks desperately sought yield outside the collapsing domestic system. Canada's move is an attempt to enforce discipline before a crisis, but the behavioral response from the banks, a necessary flight to higher-yielding international operations, echoes that Japanese pattern. It elevates the risk from being locally contained to being internationally dispersed. This is a game theory problem. The regulator acts to reduce domestic risk, and the institution counters by accelerating global risk to preserve shareholder value. The net global risk may remain unchanged or even increase. This generates a critical connection for the global investor mindset. The social psychology here is based on the concept of contagion and confidence. Canada's banks were the ultimate confidence play, the anti-contagion asset. When that confidence is deliberately punctured by the regulator itself, it forces a global de-risking reflex. Institutional investors who had placed a premium on Canadian bank stability now have to apply a Canadian discount to the risk calculation. They are asking, what does the Canadian regulator know that we don't? That questioning of underlying stability is a far greater threat than any specific capital adjustment. It is a psychological crack in the global reputation of Canadian finance. The global context is clear. Other markets see this as a warning shot. a template for how a stable nation recalibrates its systemic risk in a highly leveraged era. It's an undeniable shift, and it gets deeper. Because while RBC and TD are focused on retooling their global strategy, the most serious, least discussed impact is the direct consequence for the most vulnerable domestic sectors, the real-world impact that will quietly and permanently reshape the Canadian economy. While the financial headlines scream about capital ratios and regulatory alignment, the real story is already unfolding in the most sensitive corners of the Canadian economy. The immediate consequence of this regulatory shift is a new, invisible tax, a systemic cost that will be disproportionately borne by the two groups least able to absorb it: small businesses and first-time homeowners. The deeper question concerns the real-world allocation of credit. When a bank's cost of capital rises, the internal calculation for profitable lending shifts. Small businesses, the engine of employment and innovation, typically fall into a higher risk category in a bank's internal models. When capital becomes scarcer and more expensive, the banks will naturally triage their lending toward the safest, most lucrative clients: large corporations, established wealth management clients, and government-backed securities. The small business owner is deemed too costly in this new framework. This is the economic framing. The policy designed to stabilize the macro system is now creating micro frictions that will slow capital flow to the entrepreneurial sector, an unseen deceleration of the national economy. The surprising connection lies in the concept of financial deintegration. The pressure on RBC and TD to pursue higher yield global expansion means their domestic focus will narrow. The internal resources, the human capital, the technology, the risk modeling expertise will be redirected to scale their American and European operations. This leaves the domestic consumer not only facing higher interest rates, but also a potentially degraded level of service, fewer innovative domestic products, and a slower commitment to local community branches. This is the historical pattern. When a financial institution pivots to global growth, the domestic market is often treated as a captive, lower priority cash cow. This quiet reprioritization is the least discussed aspect of the entire policy shift. The banks are pulling a subtle but profound organizational pivot. This matters to regular people because it strikes at the heart of economic mobility and social psychology. The ability to get a simple, affordable business loan or an accessible first-time mortgage is the foundational tool for escaping economic stasis. When that tool becomes more expensive or less available, it reinforces the existing wealth structure, making it harder for younger, lower-wealth Canadians to build equity and stability. The new policy, intended as a prudential check on the banks, effectively translates into a barrier to entry for the next generation of business owners and homeowners. The market system is subtly tilting in favor of the established corporate giants and away from the domestic innovators. This is the pattern interrupt. While everyone is focused on how RBC and TD are recalculating their capital for stability, the real shift is a recalculation of their ambition, a forced acceleration toward global, higher-risk yield. The Canadian government just fired a shot across the bow of its own banking system, but the banks are simply sailing their ships toward a different, more volatile horizon. The question we must now ask is, as Canada's financial titans decouple their futures from their domestic roots and pursue aggressive global growth, who is left behind to absorb the debt and manage the quiet crisis of capital at home? Because while the world is focused on this, the real transformation is already unfolding, quietly and in a place no one expects: the unprecedented global search for a new, stable, non-sovereign digital currency.